So, one of the questions I get asked most often is with rates where they are today, I'm just concerned about the monthly payment. Now, of course, if you follow this channel, you know that we've got a lot of options in terms of our exclusive $15,000 homebuyer grant program. We've got a zero down conventional loan program with no mortgage insurance. But what if you don't live in an eligible census tract or you somehow miss the requirements or qualifications for those other money saving programs? Well, we've got an option for you, and I want to walk you through tonight temporary interest rate buy downs. I'm sure if you've searched for a home for longer than a couple of days, you've seen topics on temporary interest rate buy downs. But what exactly does it mean? And how do we calculate, what are the options available out there? And how do we calculate what that's actually going to mean for keeping money in our pockets after closing? So I'll walk you through these examples, and I hope it's very helpful. If you have any questions, feel free to add your questions to the comments below or DM me anytime. I'm happy to help. So this sheet is a typical worksheet that I use with new clients as we're getting the conversation started, usually after they apply and we go through their documentation and set them up with a pre-approval. So we have an idea for the range of home prices that they qualify for, and then we'll start to discuss each individual option in detail. So we use this worksheet to look at different options side by side and also to examine options in temporary interest rate buy down. So let's check that out. So on this sheet, we're starting on the left-hand side here with a $550,000 purchase price, 5% down conventional loan. It's a 30-year fixed rate mortgage, and the total loan amount after the down payment will be $522,000. Now at a 6.625% interest rate, which is today's par interest rate, which means no discount points and no lender credit, the payment on that will be about $33.46 per month. That's principal and interest. We add taxes and homeowners insurance and a little mortgage insurance because we've got less than 20% down for a total monthly payment of $4,248. Sounds good, right? Well, if you're a brand new homeowner, especially first time home buyers, that payment may be significantly higher than your rent payment. So, how do we ease into that payment on your new home while we anticipate and wait for interest rates to come down in the next year or two, right? So, we can do that with temporary interest rate buy downs. So a temporary interest rate buy down, as you can see at the bottom of the screen, is simply a way to reduce your monthly payment during the first 1 to 3 years of your home purchase. Now, we do that by way of securing funds from the sellers, deposit those funds into an escrow account. So that's a holding account. And then every month you make a lower monthly payment based on some reduced interest rate. And we'll go over that in a minute. And the difference between your normal monthly payment, that 42.48 above, and your new lower payment for the first 1, 2, or 3 years will be made up by the funds that the seller deposits. It's that simple. So there are many options available with temporary interest rate buy downs. So the first one here on the screen is a 3-2-1 temporary interest rate buy down. So what does that mean exactly? Well, it means in year one, you're going to pay a mortgage payment based on an interest rate 3 points lower than your note rate or the typical rate on your mortgage. So as you may recall, our typical rate on the mortgage here was 6.625%. If we pay a payment based on a rate 3 points lower, that'd be 3.625%, as you can see here in the table. That reduces our monthly P&I payment to $2,383, saving us $963 per month. Not bad, right? Especially if you're going from renting to buying. As a first-time home buyer, that extra almost $1,000 a month in savings can be huge, getting used to that new housing payment and getting used to home ownership. So the total savings in the first year is $11,553. Your total payment when we incorporate taxes, insurance, mortgage insurance, and HOAs if you have them, in this example we don't, the total payment would be $32.85. Again, that compares to the standard payment if you did not have temporary interest rate buy downs of $4,248. So, and as we go along in that process, 3-2-1 means that the second year we'll pay a payment based on an interest rate 2 points lower. The third year we'll pay a payment based on 1 point lower, so 5.625 that third year. So every year we can calculate what those savings per month will be and the total savings per the year. And then that total savings is added up for that individual program. So this 3-2-1 rate buy down, this temporary interest rate buy down, would cost a total of $23,518. Now, that's a savings to the buyer, but it's a cost to the seller. So the seller would be asked through the negotiation up front as you're making an offer on the home, say, hey, Mr. Seller, we'll give you a full price offer, but we'd like $23,500 towards a temporary interest rate buy down. We plan on doing a 3-2-1 buy down, which is going to reduce our interest rate during the first year by 3 points, giving us a much lower lower payment, which will help us ease into this purchase. So what do you say, Mr. Seller? If they agree to it, that money would be deposited at closing into an escrow account, and then your payment would be supplemented for those 3 years. Fantastic option for a new buyer looking to ease into the monthly payment with rates as high as they are today. Now, keep in mind that $23,000 may be a significant number to that seller, depending on the market, depending on the desirability of that home, how many buyers are in the area, how much competition you're facing on that negotiation. So we have other options as well. If $23,000 is too high to swing, we've got a 2-1 buy down, a 1-1 buy down, and also a 1-0 buy down. So we have 3 more options, 4 total options when it comes to temporary interest rate buy downs. So the second option we'll look at here is a 2-1 buy down. As the name implies, you're going to make a payment based on an interest rate 2 points lower than your note rate for the first year and 1 point lower than your note rate for the second year. That total savings would come out to just under $12,000 in this example on that $550,000 purchase price with 5% down. So a seller might be more amenable to providing that $12,000 in escrow funds to you at closing versus the $23,000 in the 3-2-1 buy down. So it just comes down to what you and your realtor think you can negotiate against the seller on that purchase. Let's take a look at other options too. The 1-1 temporary interest rate buy down, as the name implies, 1-1, 1 point lower than the note rate for the first year and 1 point lower than the note rate for the second year. So you're saving 1% each year, about $338 per month for a total savings of just over $4,000 per year. Obviously, that adds up to $8,100 for the total savings or the total cost to the seller. So we've got so far the 3-2-1 rate buy down at $23,500. We've got the 2-1 buy down at $11,900. And we've got the 1-1 buy down at $8,108. Now, what if it's a lot of competition? You don't think you can get quite to $8,000, but gee, you'd really like to have some savings through a temporary interest rate buy down. We can go with the 1-0 buy down, which is the most economical for the sellers and most likely in a competitive market to be able to be negotiated for the buyers without affecting your purchase price. So in a 1-0 buy down, just as the name implies, you'd pay a mortgage payment every month for the first year based on an interest rate 1 point lower than your note rate. So in this case, the note rate's 6.65%. First year, you would be making a payment based on a note rate of 5.65%, saving you $338 a month, total of just over $4,000. That's your savings as a buyer, and that's also the seller's cost to deposit into escrow at closing. So the total payment on this would be the first year, $3,910. So it gets you under $4,000. And then after the first year, from year 2 on, you would revert. If you didn't refinance, you would revert to that $4,248 payment. Now, what if you did a 2-1 buy down, and after the first year, rates have dropped enough to warrant a permanent refinance into a lower interest rate? Well, that's okay too. As a buyer, you're going to win in that situation too. What happens with a refinance is pretty amazing. So the first year, you're making a payment based on a 4.625% rate. So a much lower payment, saving $659 a month, minding your own business. At the end of that year, rates have dropped theoretically to a point low enough to warrant a refinance, but you'd still have over $4,000 sitting in the escrow account to cover that payment differential for the second year. Well, what happens to that $4,000? You don't lose it, fortunately. When you go to refinance, whatever money's left over in that escrow account that was deposited by the seller at closing is taken off of your loan balance. So your loan balance is actually reduced by, in this case, $4,054. And that would be the new loan amount that gets refinanced at the lower interest rate. So you get a boost to the loan amount and you get the lower interest rate on your refinance. It works out well for you either way. So I hope this information was helpful. Like I said, if you have any questions, feel free to post below in the comments or shoot me a DM. I'd be glad to help. Hey, thank you so much for viewing. My name is Jason Barlow. I'm a licensed mortgage advisor in Southern California, and I would love to help you save money on your next home purchase.